What's up, everybody? It's Lucas here. And look, I'm going to be straight up with you. The world of investing can seem about as straightforward as trying to read ancient Sanskrit on a roller coaster. There's a lot of noise out there, a lot of jargon, and frankly, a lot of people trying to sell you on something. But here's the truth. Building wealth through investing doesn't need to be this big, scary, complicated thing. In fact, it can be broken down into 5 simple steps. That's right, 5. So whether you're starting with a few bucks or a few hundred, this video is your roadmap to get started and, more importantly, to stay the course. Alright, step number 1. Before you even think about picking a stock or throwing money into something like Bitcoin, you gotta understand the basics. Think of it like this. You wouldn't jump into the deep end of a pool without knowing how to swim, right? Same goes for investing. First up, let's talk stocks. Stocks are like little slices of ownership in a company. When you buy a stock, you're basically betting that the company is going to grow and become more valuable over time. Then you've got bonds. Bonds are kind of like IOUs issued by governments or companies. They're generally considered less risky than stocks, but they also typically offer lower returns. Now let's talk mutual funds and ETFs. These are like baskets of stocks or bonds, and they're a great way to diversify your investments without having to pick and choose individual stocks. Now I know what you're thinking, this is a lot to take in, but here's the good news. You don't need to be a Wall Street whiz to get started. There are tons of resources available online and even apps that can help you learn the ropes. But the most important thing is to just start somewhere. Even if it's just investing a small amount of money each month, the key is to get started and keep learning as you go. Step number 2 is all about setting your financial goals. And no, I'm not just talking about retiring early and buying a Lamborghini. Although, hey, if that's your thing, go for it. What I mean is you need to figure out what you're actually working towards. Is it buying a house, paying off debt, early retirement, whatever it is, write it down and get specific. Instead of saying, I want to be financially secure, try, I want to have $50,000 in my investment account in the next 5 years. See the difference? It's clear, it's measurable, and it gives you something tangible to work towards. And here's the thing about goals. They evolve. Maybe you crush that $50,000 goal way ahead of schedule. Awesome. Time to set a new one. Maybe for $100,000 or even more. The point is, having that clear target, that financial finish line, is what's going to keep you motivated and keep you investing consistently. Trust me, there will be times when you're tempted to splurge or cash out. Having those goals front and center, that's your financial anchor, keeping you grounded and on track. Chapter 3. Alright, step number 3 is choosing the right investment accounts, and this is where things get interesting. You see, not all investment accounts are created equal. Some accounts, like 401(k)s and IRAs, offer sweet tax advantages. Now, a 401(k) is usually offered through your employer, and the beautiful thing about it is that the money you contribute often comes straight out of your paycheck before taxes. That means you're reducing your taxable income right off the bat. Plus, many employers offer something called a match, where they'll actually match a percentage of your contributions. It's free money, people. Now, if your employer doesn't offer a 401(k) or you're self-employed, don't sweat it. You've got options like a Roth IRA or a traditional IRA. These are individual retirement accounts that you set up yourself, and they also come with some pretty awesome tax benefits. Then there are brokerage accounts. These are kind of like the Wild West of investing. You can invest in pretty much anything you want, but you won't get those sweet tax breaks I mentioned earlier. Chapter 4. Alright, step number 4 is all about diversification. You've probably heard the saying, don't put all your eggs in one basket. Well, in the investing world, this is basically the golden rule. Diversification means spreading your investments across different asset classes like stocks, bonds, real estate, and even things like gold or cryptocurrencies. The idea is that if one asset class takes a hit, the others can help cushion the blow. Think of it like building a well-rounded breakfast plate. You don't want just a plate full of bacon, right? You want some eggs, maybe some pancakes, some fruit for good measure. The same goes for your investment portfolio. You want a mix of different investments to help manage risk and potentially maximize your returns over the long haul. Now, diversification isn't just about what you invest in, but also when you invest. Instead of trying to time the market and buy low, sell high, which, let's be honest, is pretty much impossible to do consistently. Consider something called dollar cost averaging. This is where you invest a fixed amount of money at regular intervals, regardless of what the market is doing. It's a great way to take the emotion out of investing and build a solid portfolio over time. Chapter 5. Step number 5, the final and often overlooked step, is to monitor and adjust your investments. Look, investing isn't a set-it-and-forget-it kind of thing. It's a dynamic process that requires regular checkups, kind of like going to the dentist, but hopefully less painful. Now, this doesn't mean you need to be glued to your computer screen, obsessively checking stock prices every 5 seconds, but it does mean reviewing your portfolio at least once a year or maybe even quarterly to make sure your investments are still aligned with your goals and your risk tolerance. Life happens. Your goals might change, your risk tolerance might shift, and that's totally okay. The important thing is to adjust your investment strategy accordingly. Remember those financial goals we talked about earlier? This is where they come back into play. As your goals evolve, your investments should too. Outro. So there you have it, guys. 5 simple steps to start investing and build wealth. Remember, investing doesn't have to be complicated. Start small, stay consistent, and don't be afraid to ask for help along the way. There are tons of resources available, and the most important thing is to just get started. In this chapter, we'll discuss the importance of continuous learning and staying updated with market trends. Continuous learning is crucial for making informed investment decisions. Stay tuned for some valuable tips and resources. Investing isn't a set-it-and-forget-it activity. The markets are always evolving, and new investment opportunities arise regularly. By committing to continuous learning, you can stay ahead of the curve and make smarter financial decisions. There are many ways to keep learning. Read financial news, follow expert blogs, take online courses, and join investment forums. Don't underestimate the power of networking. Connecting with other investors can provide valuable insights and different perspectives. Remember, the more you know, the better equipped you'll be to navigate the complex world of investing. So, make it a habit to invest in your financial education. Your future self will thank you. And that's it for today's video. If you found these tips helpful, don't forget to like, share, and subscribe for more content on building your financial future. Thanks for watching, and happy investing. Let's explore the role of financial advisors. While it's possible to manage your investments independently, a financial advisor can provide personalized advice and help you navigate complex financial situations. We'll cover how to choose a reliable advisor and what to expect from their services. First, it's important to understand that financial advisors bring a wealth of expertise and can offer a tailored approach to your investment strategy. They can help you set realistic financial goals, diversify your portfolio, and optimize your investments for tax advantages. When choosing a financial advisor, look for someone with the right credentials, such as a Certified Financial Planner (CFP) designation. Check their experience, client reviews, and make sure they have a fiduciary duty to act in your best interest. Expect comprehensive services from a financial advisor, including financial planning, investment management, and ongoing support. They should be able to explain their strategies clearly and be transparent about their fees. Remember, a good advisor will not just manage your money, but will also educate you along the way. By working with a reliable financial advisor, you can gain confidence in your investment decisions and stay on track to meet your financial goals. Investing is a journey, and having a trusted advisor by your side can make all the difference. Thank you for watching. If you found this information useful, please like, share, and subscribe for more insights on building your financial future. Happy investing. Finally, let's talk about the psychological aspects of investing. Emotions can significantly impact investment decisions. Fear, greed, and overconfidence can lead to poor choices and financial losses. It's crucial to recognize these emotional triggers and develop strategies to manage them effectively. One key strategy is to set clear long-term goals and stick to your investment plan, regardless of market fluctuations. This disciplined approach helps you avoid making impulsive decisions based on short-term market movements. Another useful tactic is to regularly review and adjust your portfolio to ensure it aligns with your financial objectives and risk tolerance. Mindfulness and stress management techniques, such as meditation and exercise, can also play a vital role in maintaining emotional balance. Remember, investing is as much about managing your mindset as it is about managing your money. By staying calm and focused, you can make more rational decisions and stay on track to achieve your financial goals. Thank you for watching. If you found this information useful, please like, share, and subscribe for more insights on building your financial future. Happy investing!